I want to cover a few different topics today, covering the right across from the state pension, across defined benefit, defined contribution, public sector. I just want to kind of go through the whole thing because there are threats, I think, to every form of pension at the moment. And one thing in particular, I think, is like a theme across the whole lot is we often hear, you know, and I hope I haven't used the word too much in the presentation here, you often hear that something is unsustainable. You know, the state pension is unsustainable, public sector pension is unsustainable, defined benefit, etc. And I think that's you know, it's not the right word for any of those circumstances. Really, what you're talking about with pension promises in the future is whether there's a will to abide by those promises. And that's a big problem, you know, in terms of anything coming out of the public exchequer. Is there a will to fund the income to current pensioners? Is there a will to fund the income for future pensioners, which is, I suppose, everybody who isn't a current pensioner? Is there the will to fund the public sector pensions? And of course that, you know, in a sense the government are, you know, you could have governments that are philosophical about these things, but quite likely you'll have governments, and this is just a general observation, who are quite clinical about these sort of things. What's the number of votes involved in doing a particular, following a particular course of action? And quite honestly, if there aren't enough votes involved in something, or if something can be slipped in without the people who are affected noticing all that much, and therefore the votes aren't affected, you know, something isn't sustainable. And I suppose that, therefore, sorry if I think it's quite important actually, a little bit long-winded, but sustainability in a sense therefore depends on who cares about it. It's not the numbers as such. So, you know, we're paying, or the Irish state is paying at the moment €230 a week to people over the age of 65. You would have seen on the TV in the last couple of weeks, not sustainable. I just take a different view on it. It's about, you know, what people care about, and it's about the government's assessment as to where the votes are, and that, you know, in turn can be affected by you know, making it known, you know, whether people care about such things. Okay. So thank you, by the way. Sorry, this lady has, by virtue of where she's sitting, just taken on a role that she hadn't foreseen at all. So this is kind of a quick overview of the working population at the moment. Around half have no funding in addition to the state pension. So around half of the working population will be entirely dependent on the state pension, whatever that happens to be in future years. And the remainder is made up of a little bit over a quarter of the entire amount, or half of the rest being defined benefit, either public sector or private, and then defined contribution and PRSAs. Now, the defined contribution and PRSAs are kind of looks okay in a sense. It's a lot of people saving in some shape for their retirement, but a lot of that saving is totally inadequate. And I will talk about the Prime Time program later, but which is a mix of facts and kind of sensationalist junk and all that sort of thing. But like, it is true to say that, you know, if you're trying to privately fund a pension of €400 a week at age 65, and if you want that 400 to increase in some way with inflation, you do need close enough to €500,000. So that, like, as anybody in the industry knows, and I know some of you are in the industry, in the financial services industry. That's not a typical sort of level of saving in defined contribution schemes. Like there's a lot of these defined contribution and PRSAs, which is effectively the same thing, aiming for really, there could be retirement funds of 10,000, 50,000 or whatever, which is obviously of some assistance to people as they reach retirement, but it's not going to generate a significant income for those people during their retirement. Okay. Just again, kind of talking generally, the last kind of official figures we have on the pensions coverage generally is, we start with defined benefit, almost 200 schemes closing during the year 2010 out of, I think it started at 1,300 and ended up as 1,100. So that's a 16% drop in the number of schemes, 32,000 fewer people within a defined benefit scheme. And obviously the schemes that are still there, 75% of them in deficit. So that's obviously a problem. Defined contribution, 7,000 fewer. Okay. I believe you. 7,000 fewer defined contribution savers. So this is, that's not a healthy sort of picture at all. So we just move on to the next one. Okay. I just wanted to bring out some figures on the state pension. Now, I'm not here to, as I said earlier, there'd be a lot of people who would look at the level of the state pension and say, right, that's shot up an awful lot. Now, it has. And, I'm not here to say that the rate it's at the moment, €230 a week, is the wrong level or it's unsustainable, all that sort of thing. But I think it's remarkable that it was fairly consistent. The blue line is the actual amount of the state pension in each year from 1990 onwards, and the red bar on top of it adjusts the actual amount for inflation since then. Now, I think it's remarkable that there was quite a number of years, all of the 1990s, where if you take the actual state pension and adjusted it for inflation up to 2011, you get a figure of less than €150. And I think it is going to, I don't set policy in this state. I have nothing to do with it, obviously. But I think it's absolutely inevitable that pressure is going to come on the amount of the state pension, and I think that will come through a partial means testing of the state pension. Now, of course, the state pension was for many years called the contributory state pension, or the contributory old age pension, and therefore it's not practical, feasible, reasonable, anything to make the state pension as it stands means tested, but I do think it'll be partially means tested, and that's, you can take that opinion or leave it or whatever, but to the extent that any of you care about the income that is paid to older people, I think it's important to anticipate where the pressure points are and where they're going to be in the future. I was looking during the week at the amount of, like 230 a week, you think, well, that's neither here nor there. It's €4.5 billion in expenditure on older people. Again, I'm not here saying, that's a waste of money or whatever, that shouldn't be. But it is an awful lot of money given the current situation. So that's why I've formed the view that, you know, there's two alternatives in terms of the state pension. It's maintained at the 230 mark. It'll fall back a little bit in terms of inflation, and you know, the younger people won't get anything near that. Or there's some kind of action taken in the next few years, probably in terms of partial means testing, which will mean that it'll be payable for future generations as well. Again, that's just my view on the thing. Again, state expenditure on older people, $4.5 billion. It's a lot of money. I'm not saying it's unjustified, all that sort of thing. This is what's already been announced. From 2014, there's a change in the age at which the state pension becomes payable. So that anybody born in the year 1960 or later, their pension, as it currently stands, the state pension will be paid from age 68. And like most people that I've spoken to don't expect it to stop there. That really the state wants a lower level of involvement in terms of these automatic pensions. And as I say, these three actions, you know, I think, and therefore the state wants this $4.5 billion, they want that to fall in real terms, and that'll either fall through the rate of benefit coming down, which would be extremely unpopular, future changes in the age of receipt, maybe up to age 70, or through partial means testing. Just in terms of the numbers of claimants as well, just one, I only want to really take one statistic, or actually 2 points from this page. The number of claimants in the last decade has increased by about 4% a year. So I didn't bother, like there's an awful lot of people who have done projections up to the year 2050 or whatever it might be. To be honest, I didn't even bother looking at those because so many people have done this already. But I thought, in factual terms, what has already happened? And we had over the decade to 2008, the rate increasing by 7.3% a year. The expenditure increasing by 11.5% a year, reflecting about 4% a year in terms of extra claimants coming through. So that I think is, to me, more real than the projections, which can be kind of hard to, when you see people projecting out to, you know, all the future decades, it's kind of hard to follow it, but that's quite real. And I think the reason I think this is I'm not kind of going around promoting this as an outcome. I've no role in it, and I probably after this presentation is finished, say no more about it really. But I think logically, to me, part of the contributory, as it used to be called, the contributory old age pension, yes, people did contribute towards that. And I'd say, you know, logically about 150 of the 230 a week, people did contribute towards it. But the other 80 was this one of the manners in which expenditure was racked up very quickly in the last decade, with the result that, as I say, the total expenditure in this particular sector increased from 1.7 billion to 4.5 billion, an increase of 2.5 times. So as I say, I don't really want to focus on you know, there's an awful lot of people, and you know, have done this on the telly or whatever, said, right, that's unsustainable. I'd much rather say, you know, that is something that, you know, is going to be, it is a problem. And you can leave a problem for quite a long period of time. Pension problems you can actually leave for ages and do nothing about it and say, right, I know that's going to be a problem. Employers in defined benefit schemes can leave it saying, oh, that's a problem, I'll look at that another day. The state can say that's a problem. It is a problem. Someday it'll be looked at when there's a political will, which again translates into votes, because the government is just kind of there as a, you know, like in a betting game. You know, if I annoy this group of people, how many votes do I lose? If I annoy this group, how many votes do I lose? That's kind of where they're at. Moving on to defined benefit, I spoke about 200 wind-ups of defined benefit schemes in 1 year. So 16% of the defined benefit schemes that existed were gone. And there were, obviously, of the schemes that still remain, a lot of restructurings in terms of benefit changes, that sort of thing. Now, I do think the last couple of points, again, probably not popular points to make at all, but I do kind of wonder whether a lot of people had their eyes closed, and people, including people like myself. You know, if you go back a couple of decades, you know, particularly the 80s and well, I wasn't that involved in the 80s, but the 1990s, for instance, it was fairly clear that there was a fundamental shift. There was absolutely bulletproof evidence of increasing life expectancy from the 80s and 90s, and by and large, the defined benefit model, which has, you know, had its origins going back, you know, perhaps 100 years, but in this country in particular, there would have been, you would have seen a lot of schemes, for instance, set up in the 1960s, when the life expectancy over the age of 65 was really quite modest. You know, you had a system revolving around a scheme expecting to pay a pension for, what, 7 or 8 or 9 years. And then we ended up the same system, the same ingredients, which were trying to deliver a pension over maybe 20 to 22 years after the age of 65, which is, that's where life expectancy is at the moment for a 65-year-old on average. You're trying to pay an income over well over 20 years, 25 years. So we had exactly the same building blocks from the 1960s that weren't really reviewed. There was very great investment performance for many years in some of the years in the 1970s were great because of inflation, and stock markets were delivering great returns. Most of the 1980s and 1990s really fantastic. Like there was a 15-year period up to the year 2000 when the average investment return was about 15% per annum. Inflation over the same period was tiny. Like this would have been when inflation was by and large stamped out. So you know, it's not that hard, and it doesn't take a genius to figure out how we got into such a mess. A lot of it is because the significant problems in the model were just obscured by great investment returns, which of course, as we all know, like the returns in the last 10 years, instead of the 15% a year it was for the 15 years up to the year 2000, the last 10 years it's been, you know, between 0 and 1%. Now that's led to all these you know, deep problems with defined benefit schemes, with 75% of them in deficit. So again, you know, like I do think there's probably a few, some small schemes that are out there that probably aren't going to survive. I do want to say though that defined benefit is absolutely, there's no argument, but you know, it is completely sustainable if there's a will to do so. It may be that, sorry, see some of you have the slides, and there's probably a couple of changes in the version I'm showing here, but not significant, I think. Now, what do you do? I think it is when you have a mismatch between a scheme that's set up, a defined benefit scheme that's set up in terms of, you know, set up on the basis of people surviving for not that long after retirement, and then the game has changed. I think there are, I suppose I'd just like to say, I think there's arguments on both sides. Like obviously if you're a member of any of these schemes, you're saying, well, I was promised something, and not only was I promised this pension, I gave many years of my life towards working in this company on the basis of the remuneration I was paid at the time, and on the basis of this pension promise. So that's a legitimate point of view. But I think it is probably also legitimate on the other side for employers to say, yes, those promises were given, but an awful lot has changed. Now, I think for a lot of schemes where there's a willingness to engage on the part of employers, if there is a need to look, if there is a scheme in significant deficit and a need to look at it, if there is a willingness to engage, there will be solutions there in terms, and unfortunately for a lot of members, it'll be a matter of pain on both sides. The employer will have to contribute more, the members will have to suffer in some way. That's an outcome that a lot of members will have to face. There's no beating around the bush on that. Unfortunately, I think the same environment, though, like the problems, have probably led to a momentum that is difficult at this stage to stop. Like I think in terms of, there's 1,100 defined benefit schemes still there. What's the best we can make from this situation, given that 75% of them are in deficit? I think the best outcome is probably employers paying more and members taking some pain as well. A far inferior outcome is just to wind up the schemes, and that'll happen in many cases. So I suppose it's a difficult thing to kind of, I suppose myself, I've a deferred pension from 2 schemes, and I don't know whether I'm going to get either of them, or in full, or in a modified form. It would be much better, obviously, to be talking, if there weren't such problems, to be given a really rosy story, but there are, and I think I suppose the point I'd make is, in a lot of cases, it's not going to feel good. You're not going to feel good if the benefits in your scheme have been changed or reduced, obviously. But it may be the best outcome that was available, and it certainly I'd be inclined as members to look towards that as a more favourable outcome than a wind-up and a replacement with a defined contribution scheme. Again, we'll have time to cover all of these points in terms of questions afterwards. But defined contribution, I want to talk about that. Now, looking at 3 salary levels, and if somebody's, well, I started the first one, somebody's earning €40,000, and if they can expect to receive the state pension of $12,000 a year. Like I think in broad terms, what a lot of people would think is good is, I'm earning $40,000 a year if my total pension was $20,000 when I retire, and if I can get my 1.5 times lump sum, if I can get $60,000 a year as a lump sum, and a total pension of $20,000 a year, including the state pension. That's not brilliant, but even that, which isn't brilliant, but probably people would say, okay, it's in some way acceptable. Even that requires funding above the state pension of 6 times salary, or $252,000. If you go up to higher earnings, and if you still want to replace say you want a 50% pension when you retire, that's going to cost you more, because the state pension of $12,000 a year isn't helping you as much proportionately as it does somebody on a figure of $40,000. So I can explain, anybody who's interested in these figures, we can go through them, but it does mean that if you're on $60,000 or $80,000 a year and you still want a 50% pension, you need your own fund of maybe 9 or 10 times your salary. So on $60,000 a year, you need €500,000, which is, given the role most employers would feel they have in this. And I suppose, like, if you look at it, who's going to provide for, your retirement or my retirement or anybody's retirement? There's only 3 entities that can help anybody's retirement: the state, the employer, or themselves. And the state, I think, for younger people, will want to minimise their involvement. For anybody in receipt of the state pension, it may be just, that is, I suppose, good luck to them. But for future pensioners, the state is unlikely to be as generous. Sorry, I don't even want to say generous, but unlikely to be as contribute as much towards people's retirement. Employers are obviously, see themselves having a limited involvement. In a defined contribution scheme, obviously they'll typically say, right, we're contributing 5% or X percent, whatever it might be, and that's it. And then it's down to the individual. And I think it's quite clear when you look at the three potential parties here, the state, the employer, and the individual, probably none of them are that inclined to really look after, yourselves or anybody in terms of retirement. The individuals, of course, we'd all love to look after ourselves, but there's never been a time when people, that's in the last couple of decades, I suppose we've become used to a particular standard of living, etc. But in recent times, people have had some surplus cash. If you go back into the 1990s and the first few years of the 2000s, but now people don't have. There's a lot of people obviously crippled by mortgage costs. If they're lucky, flat pay, perhaps bonuses being stopped. And this is just not a good time to take somebody aside and say, right, you need to contribute another €300 a month to your retirement. That's just, you might as well say, 10 grand a month. It's just not going to happen for a lot of people. But anyway, it doesn't change the fact that if you want financial independence when you retire, and say take the middle one, if you're earning 60,000 and you want a total pension of 30,000 when you retire, that means €500,000 that you need to build up, and your employer may contribute to your occupational scheme, but I'd say the bulk of it will be yourselves. Or more likely, this isn't going to happen at all. You'll end up with people on 60,000 that their defined contribution fund might be 120,000. So it's not going to generate a really strong income when people retire. Okay. This just goes through those figures, how I'm getting them in a little bit more detail. 40,000, I'm saying you need 252,000 because to get an income of 8,000 needs in capital terms 192,000, give or take. And if you want your lump sum of 60,000, well then that's a total of 252,000. So that's $250,000 for somebody on an income of 40,000 a year, and obviously proportionately higher for higher earners.
Sorry, can I ask about investments? With that money for investing, do you invest it in the markets or wherever going on that?
Well, you see, that's the really tricky thing.
Bonds, you're going with government bonds on that, or are you going?
Oh, sorry. What do you do with 192,000?
Yeah.
Yeah. That would be buying an annuity, and I think I talk about this a bit later in the slides. But I'll cover it now anyway. But buying an annuity, we've ended up in this crazy situation where a few years ago capital used to move fairly freely out of Ireland back into Ireland. That's nobody really thought in terms of where money was. If you were borrowing money off an Irish bank, that they might have borrowed it off a German bank in turn. But annuities, when people retire and if they want to secure income, by and large, that 192,000 would be put into an insurance company who would, by and large, buy German and French AAA government bonds with that money. So we end up lending money to the German and French governments at low rates of interest. There is a proposal to try and keep that money at home by allowing the insurance companies to invest in bonds that aren't AAA. It is a proposal that I hope happens. I think if you're exporting all your money, if the pension fund industry ends up, when people retire, exporting all of the money to Germany and France, it's a ridiculous situation. I'm not saying I have all the answers, but surely as a country we can figure that one out. If we did figure it out, you wouldn't need 192,000. The reason it's such a high amount of money to fund a pension of 8,000 is because you get a really low rate of return from Germany and France. You get a better rate of return, obviously, domestically, but there are other things to be figured out in terms of the Irish economy. Sorry, I'm digressing a little bit, but I think it's important. I really wish we'd get this sorted out, and if we can, there's a real corner to be turned rather than the one you keep hearing about. Like, if we can get to the stage where people invest in Irish banks with confidence and can invest in Irish government bonds with absolute confidence, it will be, you'll get a much better pension for your out of your pension fund when you retire. Okay, that's kind of the same sort of thing, so I won't bother going through that one in detail. Now, just to re-emphasize, like it sounds better if you're on a 40,000 rather than the higher income. It sounds like you only need 6 times your salary, but the difficulty with that is you're more dependent on the state pension, and the state may let a lot of us down in the future. They may not give us the 12,000 a year that they're currently giving to pensioners, and they may say, well, you're not getting it at age 68, you're getting it at age 70, whatever it might be. Okay. Just to talk briefly about public sector pensions, they have been changed a number of times. Like 1995, I don't believe it's got a huge amount of profile each time they changed in the past. 2004, they were changed in terms of early retirement being removed. So, like, the cost of funding public sector pensions for the lower grades, like for the higher earners, it's phenomenal. Like some of the figures I did over the last few weeks, there's quite a lot of public sector workers where the cost of their pension is 100% of their salary. This would be, you know, higher. The people who get promoted rapidly in the civil service, TDs, Oireachtas members, ministers, huge costs. By and large, the costs for public sector pensions are now pretty low, particularly if you look at the types of career where you don't get rapid progression, like teachers and guards and civil servants who end up maybe getting 1 or 2 promotions. The costs aren't that high. The costs were very high prior to 1995, but there's quite a number of changes came through. The cost at the moment for teachers, I think, I've done a lot of figures on this, and I should remember it, but I think it's it's close enough to 5%, certainly between 5 and 10% is the employer cost of teachers' pensions. Guards would be similar enough. Now, yet people will say this is unsustainable, and I just go back to what I said earlier. If you don't want it to work, it's, you know, if you look at any endeavour and say, I don't think I can get there, well then chances are you won't. If you look at the same endeavour in a more positive frame of mind, you say, well, how can I get there? How can I, you know, I do think public sector pensions have suffered from myths which are completely untrue, like the 116 billion public sector cost that's often quoted is completely, it's a crazy figure. It came from I talked just for a minute or so about this. It came from his Controller and Auditor General report in 2008. It's based on the premise that salaries in the public sector will increase each year by inflation plus increments plus 1.75% every year from 2008 onwards. I've said a number of times, and other people have said, if you are making changes to the public sector pensions, surely it is worthwhile getting proper information, you know, on which to make your decisions. I don't believe, perhaps the exception would be the banking bailout. I don't believe there's any significant decision of this magnitude that has been made with such poor information. And the government are well aware that the information on which they're working is deeply flawed, and I think politically they prefer to quote the old figures from 2008. Now, that little, assumption I spoke about earlier, what does it mean? If you assume somebody's salary increases by inflation plus increments plus 1.75% a year, like a more realistic assumption there would probably knock about 30 billion off that 116 billion. So it's still a lot of money. And the other thing I'd like to say about the 116 billion is nobody ever says or acknowledges that public servants have contributed through pension contributions towards that, their benefits. Okay. The proposed changes that will, like the government obviously has a very strong majority in the Dáil, but the proposed changes are career average retirement at age 68. So for a lot of, for some people this could mean 50 years of working to get a lower pension. Pension increases in line with inflation, and a provision that the pension contributions may be revised in the future depending on actuarial advice. I mentioned that CNAG report before. Okay. Now, we've done a lot of analysis on this, and based on the pension levy, if you accept the pension levy as a pension contribution, there's a lot of people would be better off with no pension scheme in the public sector. In other words, the employer is basically profiting from the establishment of the new scheme. And ignoring the pension levy, if you say the pension levy will stop, maybe it'll stop immediately, or it'll, if you say it's not actually a pension levy, it's a pay cut. The new scheme is worth around 3% for younger people who join. So it's equivalent to say the state setting up a defined contribution scheme where they contribute 3%. Okay. I just want to talk about this program, which has had a mixture, and I'm down to my last 2 or 3 slides, a mixture of truth in there and a lot of rubbish, really. It ended up being unfortunate the way it was portrayed. We certainly gave an awful lot of research to the program which wasn't used or which was misinterpreted. I think what's the good thing, I think that it is good to acknowledge that there is action required, whether you're talking about state pensions. It needs a little bit more airtime, and people, if we allow the state pension to be diluted such that younger people don't get it, and or if we allow that to happen without acknowledging how important that change would be to everybody, I think that would be a really unfortunate turn of events. I think state pensions, defined benefit, the whole lot need a lot of thought as to how these problems are going to be solved. I think it is these sort of facts. If you want 30,000 a year, that costs around about $1 million. Was worthwhile. And then the charges. I think a lot of people, a lot of smaller companies, or a lot of representatives like yourselves in companies will say, well, what are the charges in our pension scheme, and should they be reviewed? I think that's quite a good thing. The program, those of you who saw it, there's a lot of emphasis around, well, if the charges were 2.2% a year, what does that mean? That's an enormous charge, and it's completely unrepresentative. Most charges are closer to a third of that level. And so the program went off on this tangent saying, well, if this was the land we lived in, where people saving for their pension were charged 2.2% a year to do that, you could end up with 3/4 of your fund wiped out. That was a really unfortunate, and it was, it's untrue, it's unwarranted, and it probably takes the spotlight off where we really should be. There are problems. If we acknowledge the actual problems rather than making up these ones, we'd be in a far better position. So, I've no doubt there are some schemes out there with very high charges. I'm not aware of any personally. They must exist because they had this example of it. I think if there was more, yourselves, you can do some good on that front in terms of making sure whatever arrangements you have, you're not being hit with these sort of charges. Okay. So now I made this point earlier, like I think everything is under threat, and the outcome, you know, we're not all kind of spectators in this. We don't have to just watch the thing going by and see what happens. The outcome of what happens to pension schemes in the workplace and the state pension depends on, you know, whether anybody's interested, you know, and the level of engagement if it's within an occupational setting. But as regards to state pension, and the other point being the tax system, this depends. This is just, I would be entirely cynical about this. This depends on the government's assessment of where the votes are. And if they reduce the tax relief on pension contributions such that, you know, there will be some people getting 20% tax relief on pension contributions and being taxed potentially at 41% on the benefits, well, obviously that just cuts off. That means a lot of people will stop saving for their retirement. There's a very easy way of fixing all of that. But, you know, the state pension, what happens to tax relief, what happens to the state pension depends on whether they assess, you know, how many votes they think they're going to lose in it. Okay, and my last slide, I think, on the, I think there's two very easy points here. And the unions have supported the first suggestion about the investment. An awful lot of money is exported, whether you're talking about when people are retiring in terms of the annuities going off to invest in French and German bonds, or prior to retirement. A lot of pension fund money is simply sent abroad, and that might have been fine when this country had no need for capital, when there were just as many people investing here as, in fact, the 80 billion or so in pension fund assets, that would have been of no particular interest when the country was being drowned in money. We're in a different situation now, and I think it would have been much better instead of the pension levy, and countless people have said this before, including the unions, it would have been much better to try and work out an incentive to keep more of that money in Ireland, whether it's through investing in infrastructure projects or indeed if there was a way investing in government bonds if they were a little safer to do so. And the tax relief, I'd just like to make a very simple point about the tax relief. Like, I think it's nuts to have a situation where you have maybe 20% tax relief and you could be taxed when you retire at 41% on the benefits. Like, the tax relief is not a giveaway. The fact that you don't get taxed, if I contribute €1,000 into a pension, I don't get taxed on that this year, but I will get taxed on it when I want that €1,000 when I retire. So it's absolutely nuts to think, you know, you can take a 20% tax relief and get taxed at 41% on the benefits. If they do pursue this course of action, which is in the 4-year plan of reducing the tax relief to 20%, like, it would be a fairly simple proposition to say, well, right, okay, the trade-off is whenever you draw down your pension benefits, you won't be taxed at more than 20%. Like, I'm astounded that, like, is that you know, does it take a genius to work that out, that you need some sort of compatibility between the contributions and the benefits? Like, it's a very obvious point, and I can't for the life of me understand why the government haven't addressed that, to provide some sort of reassurance so that people will feel comfortable and safe in terms of their retirement saving, and that their retirement saving isn't simply a vehicle to be tapped into by the government for spending purposes. Okay, that's it.